Welcome to another edition of Taking Stock for the week ending the 25th of July, 2025. I'm Kien, Trinh, Head of Research at Stock Doctor. And joining me today is our Senior Equities Analyst, Jason Yin, as we break down the key developments across the markets and some important updates from our star stocks. It's been quite a hectic week as we've been moving offices. Jace, how have you been?
It's been pretty good, Kien. So it's been weather's been pretty cold, and moving offices has definitely heated our bodies up a little bit. So it's been a pretty interesting move.
Yeah, you don't really realize how much you have until you actually start
That's
moving,
right.
Jace. But before we begin, just a quick but important reminder: the information we provide today is of a generic nature and shouldn't be considered personal advice. Remember, shares are volatile, so any past performance figures aren't a reliable indicator of future performance. Well, Jace, in terms of the markets, it's been quite a week, with rotation across the equity markets after months of strength in the banking sector. Investors' attention is now shifting towards the resources, which stage quite a strong comeback with our star stocks like BHP and Rio Tinto outperforming.
That's right, Kien. And also major banks pulled back from recent highs as well. And this is on the back of bond yields, which have steadied while resource companies, especially those in the energy and bulk commodity space, outperformed. The optimism was supported by China's stimulus measures, including plans to build a mega dam in Tibet.
Yeah, that's incredible there, Jace. But market sentiment, they continue to be quite optimistic on easing trade tensions as well, with news that the US and Japan have reached an agreement, while Europe is also nearing a trade deal with the US as well. On the corporate front, though, you saw tech stocks, they continue to perform quite well. And that's helped by the reporting season in the US, with Alphabet, for instance, beating market expectations on surging demand for its cloud-based products and services.
Yeah, it was a pretty good performance from Alphabet, but closer to home, Kian, retail remains under pressure, and this is following weaker than expected trading updates from automotive parts business Babcor and also online underwear retailer Step One. This also suggests that there are risks, and potentially this could flow on to other retail names within our coverage list, and that could include Super Retail Group and potentially ArbCorp as well. So those who are exposed in these names, please ensure that you are well diversified and also have limited exposures in these stocks.
Yeah, definitely. We've been talking about the risks in retail for a few months now. So this reporting season will be interesting, especially across some of those stocks with negative earnings revisions. But let's now turn our attention to a niche platform provider, Praemium. They delivered quite a strong fourth quarter update. Funds under administration, it reached about 64.3 billion, and that's a 15% increase year on year. And these figures were broadly in line with expectations, showing quite a strong growth in client and advisor engagement. But the market reaction was quite weak there. What's the reason behind this, Jace?
Well, we believe this was driven by the market's focus on inflows, which had slowed down from the previous quarter as the business deals with transition issues. OneView, for example, was acquired in 2020, and this has been phased out in favor of a Spectrum, which is to consolidate clients onto a more modern and scalable infrastructure platform. Also, as well, you've had PowerWrap, and that recorded further advisor-driven outflows, but management indicated that this should stabilize over time.
Yeah, quite interesting, Jason. One key positive was the recent win of the Bell Financial Group contract, which should contribute about 10% to Praemium's total funds under administration. And this is quite meaningful, and it does endorse the business as a major advice firm. And that's expected to bring significant platform inflows over time as well.
That's correct. And it's also worth noting that clients from the OneView platform are voluntarily choosing to migrate to Premium Spectrum platform. And this is rather than moving to competitors, which indicates a pretty strong signal of confidence in that platform as well. So we believe any volatility in this stock could present a pretty attractive opportunity for investors, especially given that Premium continues to trade at a discounted valuation multiple to peers like Hub and also net wealth as well. So the upcoming reporting season in August will definitely be an important catalyst to watch out for.
Yeah, definitely, Jason. And moving on towards the energy space, let's take a look at oil and gas major Woodside Energy, which released its second quarter production and sales report last week. Production rose about 2%, but revenue actually dropped by about 1% over the quarter. And that was driven by lower prices. Interestingly, the stock has rallied over 10% in the past month. What's driving this divergence between earnings expectations and share price performance, Jace?
Yeah, fantastic question, Kien. Part of it is macroeconomic driven. So, for example, if we have a look at the Brent crude price, this has rebounded above $80 per barrel and has improved sentiment towards oil producers. But there's also been company-specific news. For example, the Sangomar field in Senegal has successfully commenced production, and that's a pretty important milestone that should lift output and also improve operating leverage in the coming quarters.
Yeah, and I also noticed, Jace, that the business sharpened its full year production guidance and also slightly lowered its cost guidance, and this should provide more clarity around its outlook. I also note that there's negative earnings growth over the next 2 years, but that represents a combination of lower energy price assumptions and the natural decline in legacy assets, such as the sell down of Scarborough.
That's right, Ken. And also, in addition, the elevated capital expenditure tied to developments across the Beaumont ammonia and also Louisiana LNG and Scarborough LNG projects are not expected to produce production until FY27.
Yeah, very, very interesting there. And thanks for the clarification. And with the reporting season on our doorstep, there should be a few star stock updates in coming weeks, including Rio Tinto and ResMed to start off. So look out for that one. This week in Under the Microscope, we're taking a closer look at global resources heavyweight BHP, a holding across both our Star Growth and Star Income portfolios. Now, in terms of revenue mix, BHP has around 55% iron ore. You've got 25% from copper and the rest from coal, nickel, and its emerging potash segment. This level of diversification makes BHP more resilient across commodity cycles. But Jace, how is the business actually performing?
Well, from an FY25 perspective, Ken, this actually exceeded management's revised guidance across most commodities. However, full year revenue and earnings were lower year on year, and this reflects softer pricing and also cost pressures that have crept through the profit and loss. So, outlook wise, everything looks pretty solid. Production volumes across key commodities expected to remain stable, but on the whole, negative growth outlook reflects softer iron ore assumptions over the next few years.
Yeah, and a major development this week was the cost blowout and delay at the Jansen Potash project in Canada. Phase one capex, that's been revised up by around 1.4 billion to around 7.9 billion. And first production is now delayed to late 2026, 6 months behind their prior guidance. While this is disappointing, the market largely absorbed the news given the long dated nature of the project. Still, it's a reminder that large-scale resource projects do carry that execution risk, and persistent cost overruns could eventually constrain the company's ability to maintain or grow its dividends and also return on invested capital. So, Jace, how would this impact its free cash flow and dividend expectations moving forward?
Well, this is a question that many investors have been actually asking, Ken. So BHP attributed the increase in terms of cost to rising labor and also materials, as well as any scope changes that was required to complete some of the infrastructure that was in place. No doubt, forecast free cash flow is expected to be revised lower from analysts following this announcement, and this could potentially lead to a downgrade in terms of earnings revisions and also dividends expectations as well. However, the forecast figures on Stock Doctor are influenced by many factors, including changing commodity price assumptions. So, for example, although the free cash flow is expected to decline over the next 2 years, there appears to be sufficient margin above the dividend payments for us to retain the stock within our Star Income portfolio for now.
Right. Yeah, that free cash flow looks still quite strong despite the fact that it is declining. The dividend yield also looks quite reasonable, currently at around 5% fully franked, with an unstretched payout ratio of around 50%. And if iron ore prices, if they can hold above that $100 US per ton, then the company can continue to generate that strong free cash flow. Forecast currently at around 2.35 cents per share this year. So looks like the dividend does appear well supported for now. But over time, this could change. You've got sustaining capex, That's expected to rise to around 10 billion this year, US, and likely higher in financial year 26 as Jansen ramps up. That puts pressure on the free cash flow coverage ratios, and any major pullback in commodity prices could also see the payout ratio trim. So we will be monitoring developments closely and reevaluate BHP's income star stock status after it releases its results around mid-August.
Yeah, good points, Kien. Investors also have to remember that there is a risk that BHP will be removed from our star growth portfolio after its FY25 results, especially if its return on investor capital declines to around 33% as forecasted by the current numbers. Although this is very high from an absolute perspective, the decline is relatively large and implies that resource stocks are experiencing a bit of a contraction in the commodity cycle.
Yeah, and one final point there, Jace. While BHP is one of the most widely covered stocks on the ASX, it's also important to remember that earnings forecasts and the valuation for resource stocks can change quite quickly over time. And that's because analyst models are highly sensitive to commodity price assumptions. Hence, it's more useful to focus on what you know with certainty. And that's putting emphasis on BHP's operational quality, financial health, and balance sheet strength, and also their cost discipline when forming a long-term view. Now to question of the week. One of the key financial metrics we look at to identify high quality growth companies, especially with the one that we looked at for BHP just earlier on, is the earnings quality. So what does earnings quality mean, Jason? Why is this so important?
Well, earnings quality refers to how reliable, repeatable, and also how sustainable a company's reported profits are. So, high quality earnings are mainly derived from core or ongoing business operations rather than one off items.
Hmm.
They're calculated using transparent and also conservative accounting practices. And lastly, supported by actual cash flows rather than just accounting profits or adjustments.
Yeah, and in contrast as well, Jace, low quality earnings might be inflated by aggressive accounting, non-recurring gains, or other manipulations that don't reflect the company's core economic performance.
That's right, Kieran. And that's why it's pretty important that we define earnings quality through the lens of strong cash conversion and also low accruals, which indicates that a company's reported profits are backed by actual cash flows. Now, this ratio or the accruals ratio that we display in Stock Doctor is then standardized into three brackets, being strong, neutral, or weak.
That you might look at this and go, okay, what happens when there's a drop in earnings quality? Well, this could be an early warning sign, but it's not always a red flag. For example, businesses with large contracts may receive cash upfront or at the completion of that project, causing temporary mismatches with reported earnings and cash flows. In these incidences, it's important to look past the headline numbers and consider the context, especially for otherwise high quality companies. That's all we have time for today. And if you have any questions or comments, feel free to join us for our Lincoln Live webinar this Monday at our new Southbank offices. Jace, it was a pleasure to have you on board again.
The pleasure as always, Ken. And also with reporting season just around the corner, it's a great time to review your portfolio, focus on quality businesses, stay diversified, and also have some cash ready to take advantage of any opportunities as they surely could arise.
Yeah, and thanks everyone for tuning in. Take care and have a happy, healthy, and prosperous week ahead.